Hello friends, hope you're doing great. Welcome to our channel. In this second video, we will cover option, call and put. We did talk about option and related it with insurance and tried to convince that okay, option is a hedging instrument, financial instrument to hedge your portfolio. Now, quick disclaimer, education purpose only, no investment recommendation. It's your money, so be careful. We covered options. Just a quick recap: options are financial derivatives that give buyer the right, because you are paying the premium, you are the buyer, and but you get the right to buy the underlying, but you do not have any obligation. May you buy it, may you don't buy it, but you have to pay a premium. Okay, you get the right to buy or sell an underlying asset, may that be nifty, may that be any other commodity or underlying asset, at a predetermined strike price, that insured value or a price which you would like to buy at. We'll discuss it further also. And there is a specific expiry date. So couple of things: one is, for a buyer it's a right, no obligation. He can buy, he can take a contract to buy, or he can take a contract to sell, whatever it is. Strike price is already fixed. Strike price is different from spot price that we discussed already, and there is an expiry date to it. This right comes at a cost and known as a premium. Okay, this we so far we discussed, but now we want to talk about what is this option, what are the categories of it. Okay, so that let's jump on to it. But before that, let me revise this example with you for Reliance company, because I will use it again. So there is an underlying stock of Reliance company, and we want to place a long call. Long means buying a call option. Okay, at a strike price of 2500. Maybe today at market, Reliance share may be at 2400 rupees. That's a spot price. Today's market price of Reliance may be 2400, but I am trying to buy it at a strike price of 2500. Why that? We'll discuss that. Okay, expiry date for this contract or option is till 30th November 2025. But to get this right, to get this or buy this right, I have to pay a premium of 50 rupees. I take a pause here, right? As a buyer, if you want to buy a Reliance share today and you have a mindset that it might go to 3000 rupees. Okay, so let me buy it now. So if you buy it now, you have to invest 2500 rupees. But then you say, no, I don't want to take that much risk. Maybe if it goes to 2000 rupees, I'll lose money also. So you say, okay, let me buy an option for it. I just pay a premium of 50 rupees, and the insurance or kind of hedging I receive from the writer, that till 30th November, I will go and buy the Reliance. I'll have to pay 2500 rupees because that's a strike price. If tomorrow the price goes to 22,000, I will not buy and let this 50 rupees go waste. That means my premium becomes zero. Okay, so till 30th November, the scenario stands the same. Okay, so I move ahead and let's understand the categories of option. You remember I said I'll not use terms option seller, rather I'll use term option writer. So let's see how I relate it. So whenever we go for an investment or whenever we go for a trading, the basic premise is that we buy it low and sell it high. We buy cheaper and sell it high. I'm not only talking about financial industry, you talk about any other industry, manufacturing, export, import, trading, anything. Premise is that you buy low, add some commission to it, sell it high. The secret of building incredible wealth for the future. Same rule applies in option. I'll simplify this learning very much. So just stay with me. Now, option has two categories to it: call and a put. As a buyer, I am focusing on buyer right now. As a buyer, if I buy something, okay, if I buy something, the premise or my understanding it, I am buying it now with a view that it's an investment for me, maybe for 5 days, 10 days, or 1 day, or 1 year, and sometime I'll sell it at a higher price. So that's a basic premise, right? So that means As a buyer, I have a direction in my mind that the price will go up, movement will be in up direction, I will sell it. But in case my direction is, or my viewpoint is, that the stock of Reliance, no recommendation, stock of Reliance might go down, so that means I got a negative direction. Then should I buy it now? No, I should sell it now, because my understanding is the price might go low. So I sell it now and I buy it later. So the options give you this power that you either buy now, or you either sell now, or you don't do anything, just buy an option from the writer that is a right to buy or sell at a later date within a specified expiry date. Maybe I confused you, I am sorry, but let's review it in different words. Option give you two category. One is call. As a buyer, when I have a visibility that market or stock or any underlying will go up, that means I am focusing on a up direction, I buy call. That means I am bullish. When I have a, on the counterpart, when I have an understanding that market will go down, or stock will go down, or any underlying asset, maybe Jira, or maybe copper, or maybe gold will go down, then I will buy put. So please understand, I am option buyer. I am already doing long, and I have two options: either buy a call when I am bullish, or either buy a put when I am bearish. I take a pause here. When I was buying an insurance, my only focus was to save myself from any theft, accident, or any of the third party liability, right? For in case of insurance, there my only viewpoint was to save my risk, isn't it? But my all possibilities were that I will have a financial loss, which can be covered by car insurance or bike insurance. But in this case, I am seeing a two direction. One is either the underlying can become more costly, or either the underlying become more cheap. And on that basis, I am making a call or a put. Even if you did not understand now, no problem. Just relate it this. If I think market will go up, I will buy a call. If I think market will go down, I buy a put. But please understand the other side also now. When I think market will go up, so I want to buy option. But the seller or the writer who is selling you this option, or who is writing an option for you, he should have a opposite view. If he also think that market will go up, then he will not sell you. So all the time in the market, all the time in any OTC, over the counter trading, two parties come together when they have a contra view. One is thinking market will go down, other is thinking market might go up or might stay there. So writer is always having a opposite view. So when for call, for a buyer, it's a bullish view, but for seller or writer, call is a bearish view. So when he writes a call, that means he has a bearish or neutral view. Same way, when a buyer buys a put, he has a bearish view. But when a seller or writer sells the put, he has a bullish view. Even if you don't understand, no problem. Just remember this chart. Option has two category. Call, that means green arrow up, that means market will rise. Put, that means market will fall. Now how buyer is behaving to this? If it's call, buyer is bullish, green color, but seller is bearish or neutral. That means market will not go beyond this point, up beyond this point, or it will stay here only. On the put side, when it's down, bearish, buyer is bearish, but seller is saying maybe market will not go beyond, go below this point, or market will stay there maybe. So always buyer and writer or seller has a different view, and that's only the way they trade. They make the trade. Okay, with that I move ahead. Recap of what we discussed earlier. Option trading, you have got a buyer, you got a writer. Writers are generally the risk takers, speculators, maybe the bigger financial institutes, banks, or the traders. When they sell the call, they have a bearish view. When they sell the put, they have a bullish or slightly bullish view. They always have an obligation to execute the trade, but no right. But on the other hand, because buyer pays the premium, you and I as a buyer pays the premium, we pay the premium and get the right to execute the trade. We are the hedgers. We are insuring ourselves from the risk. We are maybe the retail user, retail trader, manufacturer, agri producer, or any company. Buyer's aim is two aims, right? One is reducing the risk or hedging. That's insurance. That's why I mentioned partially I am explaining derivative via insurance, because buyer's aim is reduce the risk, hedge himself, reduce from any future financial risk. That's why he goes for an insurance. But then for the market or stocks or indexes, we have another problem. That's a price fluctuation. Price might go up, price might go down. In that case, what we do? We buy call when we think market will go up as a buyer, and we go for bullish sentiment, and we buy put or bearish sentiment when we think market will go down. Okay, this we have already discussed. So just a quick recap. I purchased a contract for Nifty 14th October 25,500 CE. That means strike price is 25,500. That's the point. That's the price which I would like to buy Nifty at 25,500. If Nifty closes at 25,400, I'll make loss. If Nifty, because I bought costly, but if Nifty closes at 25,700, I'll make money. So strike price is the price at which you will buy and sell. Spot price is current cash market price. Premium is what I pay to buy that right. Option expiry is a timeline for that contract. For this contract, it's weekly. Underlying asset is Nifty 50. Okay, there is another concept of American option versus European option. In India, most of our options are European, so you don't need even to worry about it. American option is owner of such option can exercise the right. Owner exercise the right. That means they're talking about the buyer. Buyer can exercise his right at any time on or before the expiry date or date of the contract. But in European options, which is applicable most of the cases in India, that owner of such, that means option buyer, can exercise his right only on expiry date. That means we can only exercise or execute options at expiry. What does that mean? I purchased option for 30th November for Reliance, and I said I buy 100 option for Reliance at 2500, and the expiry date is 30th November. If I am on American option, that means on tomorrow, 15th October, I can go to the seller and say, give me Reliance share and take the money, 2500. That means I am exercising it tomorrow, much before the expiry date. But in European options, this is like better from seller's perspective also, that we will take an execution. I as a buyer will take the Reliance share only on 30th November, that is expiry day. Okay, so that's the only marginal difference between American and European options. With that, we take a pause here. What we discussed is what is call, what is put, what is view of a buyer, and what is view of the seller. Okay, and please do, even if there is a one word which you don't understand, do write that in comment, do share your feedback, and please subscribe our channel. Thank you very much.